Hi there, thanks for tuning in again. I am still Sam Carroll, and this is video 4 of a still unnamed personal finance video series. Today I'll be covering two related topics. One, the whispers of concern from around the financial media, and two, how to understand the current predicament from the perspective of your money, and in particular, your cash. Are you tired of hearing me say already, "There's trouble ahead, there's trouble ahead"? Well, good news. Today I won't really be doing that. Instead, in part 1 here, I'll be letting other people do that. It's time you heard from some other people here, in case you're looking for a second opinion, or a third, or a fourth. And in part 2, I'll add a crucial perspective on how to understand the predicament we are in through a deeper understanding of money and debt. In particular, having an appreciation of cash and cash-like instruments is important, both to your emergency fund, which you've totally set up since we discussed this in finance video number 1, right? Right? But today we'll further delve into the power of cash and the opposite of cash as well. What do I mean, the opposite of cash? Well, stick around. So first, here's a bit about what other investors are saying out there. With the clear warning signs I've shared in the previous video in place, many other market participants are sounding a note of caution right now. This New York Times article from last year warns of the overabundance of student debt, credit card debt, and corporate debt. This situation has led Paul Tudor Jones, a giant in the hedge fund industry, to warn of a debt bubble which he concurs was created by central banks. And with today's high stock market valuations and a variety of economic headwinds, many prominent investors are taking a precautionary stance. The most famous value investor in the world, Warren Buffett, is now holding $122 billion in cash, far more than he did ahead of the 2000 tech bubble bursting or the 2008 financial crisis. And it's simply because as he said, he cannot find any sizable companies to buy that are fairly valued. Another prominent investment manager, Scott Minerd of Guggenheim Partners, sees a greatly overvalued stock market as well, and has forecast a 40% decline. But it's not just well-known voices sounding a note of caution, it is investors of all kinds. Earlier this year, CNBC found that US investors in all were holding over $3 trillion in money market funds, which are cash-like investments. That's nearly 15% the size of the overall US economy. And in a value investing social media group in which I'm active, one of the most often mentioned investment positions these days is cash. It's worth noting that some of these warning signs were issued over a year ago, and there's no prize for being early. But overall, fundamental conditions really haven't changed much since then. Of course, there are plenty of financial market commentators who are saying everything is fine. And yes, it certainly is for now. But they often point to lagging indicators like backward-looking economic data from the past month or the past quarter, and they often also incorporate optimistic future earnings estimates into their models, in which case they are talking about things that haven't really even happened yet.
I have to tell you about the future!
So how will things go? Well, I'm not trying to predict the future here, as I've said. Nobody's really good at that. I'm just saying that I've seen a similar movie before. We all have, around 2007. So, in a country awash in debt, what do we do to move to safety? Well, what do you do if everyone on a boat is crowding to one side and the boat begins to appear like it might capsize? You quickly make your way to the other side of the boat and maybe look for a life jacket. So if the world is awash in debt, and you know you want to move to the other side of it before the system maybe capsizes under that debt, you might ask, what is the other side? What is the opposite side of debt? Well, the opposite side of debt, in a practical sense, is cash. Think of it this way. When you borrow $1 from a bank, you don't really have $1. You have $1 in liabilities, in debt, because you now owe the bank $1. It's true you also have that dollar in your hand as an asset. But if you invest that dollar in a $1 stock and the stock loses 50% of its value before you're able to pay back the bank, then what do you have? A problem. You have a problem. It's a very small problem, of course, but in a more realistic illustration at scale, if you owe the bank $400,000 on a mortgage, how do you erase that debt? With $400,000 in cash, plus interest, of course, paid back to that bank over time. Probably paid back with your current income. And again, if you suddenly don't have the cash to pay your mortgage, what do you have then? You have a problem, a very big problem. This is purely hypothetical, of course, unless you're one of those millions of Americans who got laid off or saw their earnings fall in the last recession and then struggled to pay their bills. Now, these are stupid, simple scenarios here, but I'm trying to help you see how, as an investor, you can benefit from understanding debt as the opposite of cash, and therefore cash as the antidote to a world awash in debt. And since we're all in this boat together, when everyone's holding too much debt, you might want to just consider moving to the other side. So how do we do that? As I said in video 2, putting cash under a mattress is not what we're talking about here. Or was it video 3? Well, one of the previous videos. In any case, I suggested building an emergency fund as a financial buffer, and I mentioned early on a few cash-like instruments that you can access as a retail investor. Savings accounts, money market funds, certificates of deposit, a short-term U.S. Treasury bond index fund. Not one of these is new, and not one of these is sexy. But you don't want sexy right now, do you? Well, not where your finances are concerned. Safe and effective may be what you want, right? Plus, all these instruments I just mentioned offer you income. And as of August 2019, each offers more than 2% income, although that can change. Who doesn't like a little income, right? Well, that's it for today. Thanks for listening and watching. Coming up in video number 5, I think, I'll be covering a scenario where everything could be okay, but just okay. And just okay for a long period of time, potentially. A quick hint on that. If you'll recognize this reference, we could be turning Japanese if we play our cards right. Well, that's it for now. So lastly here, a disclaimer. Again, this material is offered for informational and educational purposes only. No part of this video constitutes personal, financial, or investment advice. I assume no liability for any losses arising from any financial or investment decisions made based on the content provided herein. For personal financial advice, always consult with your financial planner or your registered investment advisor. All right, guys, thanks for sticking with it today. That's all I've got. Thanks again for watching. I will see you next time.